Hi everyone, it's Manny here. So today, following our series on the Brent complex, I'm going to be talking a little bit about cost of keep. So as always, if you have any questions, don't hesitate to message me or write in the comments below. Thank you. So following the theme from our previous videos, I'm still going to be speaking about these 6 individual components as we go through speaking about the cost of keep. So I'm going to use an example on why a trader would hold a cargo into pricing rather than selling it on to a refiner before it gets to pricing. So let's say on the last trading day of August, say for this year that will be August the 28th, all BFRET physical programs are released by their respective terminals. So generally, producer companies know their equity and therefore have some expectation about their monthly volume in each oil field. So let's say Shell expects 140 cargo in October. Now earlier in the year, Shell forward sold flat price against this Oct loading cargo. Now they could have done this at any point of time. It's up to them, their particular view on the market, etc. But they would have done it in the form of an October cash BFRET contract. So let's say they sold one contract to BP at $50 a barrel. So here, in order to execute this trade, they would have sold 600,000 barrels of October Brent futures in the futures market, and then they would have sold an Oct EFP to BP. And let's say they executed this trade in June. So when the 40s program is then released on August the 28th, the terminal will issue that one cargo against Shell, and let's say the loading dates for it are October the 1st to October the 3rd. Now Shell will look at the market price, and let's say it's currently trading 45.25 for October, and they then decide to utilize this forward contract to sell this October loading 40s cargo to BP at $50 a barrel, which they had executed back in June. So now this particular cargo, the 1 to 3 October loading, they can sell it in many ways, as we've previously discussed in the lectures. So it can be sold as a wet or dated crude oil cargo because it already has the dates attached to loading, or as a forward BFRET contract, which they have done with BP. So a BFRET paper contract becomes wet or dated at 4 p.m. 30 days before the first day of the loading window. So for a 40s cargo that loads Oct 1st to the 3rd, the cargo becomes wet or dated at 4 p.m. on September the 1st. So now on September 1st at 4 p.m, BP have a 40s cargo that prior to 4 p.m. was a paper BFRET contract. So they have converted their paper BFRET to Dated Brent. So what is the difference between Oct BFRE and Dated Brent? A physical 40s cargo can trade in the Platts window from a month before loading up until 10 days prior to loading. So Oct 1st to the 3rd, loading for 40s, can affect and trade in the Platts dated window between September the 1st and September the 20th. So BP now own this wet cargo and would aim to sell at the highest price point of the dated curve. So as we're currently in contango state, this would be as close to September the 20th as possible. So here, as demonstrated, we need to take a look at the structure of the curve and whereabouts the individual weeks are priced to see where September the 1st to the 20th of dated is priced against October BFRET. So as I've shown here, let's say the CFD, and in this case a CFD is defined as September dated against November BFRET. Let's say for Sep 1st to the 4th, the value of dated is $1.40 less than the NOV BFOET paper contract. And for the 7th to the 11th, it's 127 cents a barrel less. And for the 14th through to the 18th, it's 123 cents a barrel less. So if we average these over that window of time, we get an average of dated being $1.30 lower than a November BFOET price. However, because we're looking at keeping an Oct BFOET cargo, we need to look at where the Oct NOV Brent spread is. So let's assume this is worth 60 cents, i.e. October BFOET barrels are worth 60 cents less than November loading BFOET barrels. So this means that the dated average over those dates, over the 1st to the 20th of September, is 70 cents lower than October BFOET cash. Now, because a cargo is 600,000 barrels, this means that the keeping cost of this 40s cargo loading from the 1st to the 3rd of October is 70 cents times by 600 kb, which amounts to $420,000. So by calculating that, this means that when deciding whether to hold the cargo into pricing or to sell it, we must compare the price someone, say a refinery, will pay for the cargo against that $420,000 it costs to hold the cargo into pricing, until BP will then either price it out or sell it in the Platts window as a wet cargo. So BP initially bought the cargo back in June at $50 a barrel, plus the 70 cents, which is the cost of keep. So these two together, $50 and 70 cents, will be the price that a refiner needs to pay above for BP to have some incentive to sell that cargo to them. If not, it will be in BP's interest to hold that cargo into pricing. So let's now go back to how BP would have actually hedged their offloading cargo back in June. So they bought one Oct EFP in June from Shell at $50 a barrel. Now, because, as we've mentioned before, the liquidity in CFDs is only around 2 months forward, but for DFLs it's much farther out, probably around 12 to 24 months forward. So in June, BP would have hedged their Oct loading cargo with a SEP DFL and Oct NOV Brent spread. So by August, as the liquidity in the CFDs picks up for September and BP are given their loading dates by Shell, or they're able to infer through the curve whereabouts they're expected to be delivered the cargo, they can then convert their general SEP DFL into an accurate SEP 1st to the 20th CFD hedge. And depending on what they do with the cargo, they can either unwind it when they sell the cargo out, or it will price out as their cargo does in the Platts window. If you have any questions on the cost of keep, please send me a message or write in the comments below. I'll be happy to get back to you. Thank you.